Welcome to the Aramir Roundtable. I've got Scott with me from Stratagem Trade, also known as j.l.lord. And before we get started, just a quick disclosure, Aramir Corporation is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We're not making any specific trade recommendations. We don't know your situation and have no way of knowing what level of risk is appropriate for you. The risk of loss in trading options can be substantial, so please be aware of all the risks prior to placing any trades. Past performance is not indicative of future results, and hypothetical computer simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. So with that, just a quick intro. I know your BWDB book has been pirated all over the internet, I'm pretty sure. It's been around for a long time. And
I know, I heard you were too cheap to buy it. You got a bootleg copy too.
Well, I saw it. I did see a copy. I didn't read it because I didn't feel it was right, but it was a.
No, just kidding.
It was a poorly scanned one.
I'm just kidding.
But yeah, I know it's good stuff, and Scott's been around for a long time. A great trader. I'm happy to have him here. I did Optionetics a long time ago, and I think I remember your name back then. But yeah, it's a pleasure to have you here, Scott, and you're going to talk about risk reversals. I'm sure we're all looking forward to that.
Great. And it's nice meeting all you guys. I too have a disclaimer, but it's not as good as this Major Tom's disclaimer. But we're going to be talking about risk reversals today. And our disclaimer just says the same thing. We're not acting as a broker dealer, even though I was a floor trader on all the exchanges in Chicago. And we show a lot of real-time examples in class. None of them are meant to be in a advertisement for any specific trade. We're just doing trades as examples so that people can see a more realistic approach as opposed to back testing, which is important but allows one to lie to themselves. In hindsight, everybody knows that they should have bought the stock market after America's 2016 elections, and so back testing, you may have like confused or be able to lie to yourself and say, well, if I got long here, all the trades that we do in our pot class, which we hold Wednesday nights, are just simply because we don't have the ability to lie to ourselves. So anything you guys see here, any examples we've done, are just for illustration and education purposes only. We're going to go really, really fast. I've got 90 minutes with you guys and about 90 slides. So that's 1 minute a slide. The great thing is Tom's recording this, so if I go too fast and you guys get lost, you can go back and plead with Tom to get a copy of the recording. Like Tom said, you know, I was a floor trader on the exchanges in Chicago since 1985. Some of you guys, if you were at Optionetics Oasis ever, may have met me. I was on the main stage a couple times talking about the BWB because I was the first one to write a book about it. Around the time that the internet and the brokerage platforms were getting good enough where I didn't have to fight 2 hours of traffic downtown Chicago every day, I started trading from home. Just like, well, probably half of the floor traders did. I was the head of trader and instructor at Trade Secrets, Optionetics, and Stratagem and Random Walk. Actually, I used to own Random Walk, but my partner and I decided to go in different directions in this industry. I've taught on the main stage at many places where 2,000–3,000 people were common. I've written about 16 textbooks on trading. Most people only have heard of the Broken Wing Butterfly book, but we're getting to be pretty big in Italy. Other than that, I'm not going to really give you my resume too much, just let you know who I am. And that's it. Let's get going with tonight's education. I want to thank Tom for all the work he's put into setting this up. There's a lot more that goes on behind the scenes than you see, and Tom is really fighting for you guys. We don't do discounts ever, other than to our own students who are in a particular classroom at the time, and Tom has been fighting really hard to get you guys a discount, and so we'll talk about that for 2 seconds. I'm the world's worst salesperson, so you're not going to be getting a lot of sales, but we will tell you what Tom fought for you. Anyhow, some of you guys may have read about us in Stocks and Commodities. We've written a lot of articles for that. Like I said, I was on the bond futures pit, which is on the Board of Trade. I was in the S&P 500 futures pit, which is on the Chicago Mercantile Exchange. And I spent most of my time in the OEX, which is the S&P 100, and the S&P 500 options pits, which is on the CBOE. Other than that, you know, you can go back and look at the slides later on and see more accolades, but I'm not here to pump myself up. I'm here to pump up the strategy that I really love, which is risk reversals. And we too have our own classes every Wednesday night. We call it POT class, Practical Options Tactics. And I would say probably 20% of all trades we enter into start with a risk reversal as the starting point. We'll take that risk reversal as a replacement to vertical spreads and play with it. And the great thing about these risk reversals that you're going to see tonight is they can be manipulated into something else. It is not uncommon for us to start out with the strategy that we open with as a risk reversal and take one side of that risk reversal and turn it into a broken wing butterfly, because it's already halfway done. The broken wing butterfly is already halfway initiated when we enter into a risk reversal. So these are very pliable, flexible strategies to play with. But first you have to learn what it is. Now, here's the history of the risk reversal, and I'm just going to go through it real quickly. A risk reversal's definition is just a position that uses a call and a put, or a call spread and a put spread. On the trading floor, I didn't have that much margins. We'd have what we call risk-based margins. We could trade huge amounts of risk for very little money. And so typically, I would just do this with a call or a put. When I started trading from home, I became a customer account, just like everybody listening in. And so margins would get crazy expensive fast and had to adjust everything accordingly. And so instead of using a naked call or a naked put, I then began using call spreads and put spreads for the defined risk. But most people starting out in this industry don't even know what an option is. Their initial beginning in this industry or investing is just simply go out and buy a stock. They're taught from a very young age, you just buy stocks and eventually you're rich when you get old. And the problem with stocks is, what if the market declines? And if you've ever gone through a major market decline, like when the NASDAQ bubble burst in 2000, or the 2006, 2008 to 2009 housing crisis, or 1987, which is about when I started in this industry, you quickly learn that downside of stock it can be very painful, and you want to learn ways of hedging it. And then you eventually hear about options and the light bulb goes on and goes, wait, I can buy a put that eradicates his downside risk. I've got to learn more about this. There is a problem though, when you'll go out and you'll buy a put your first couple times, and most people's experience when they go out and buy a put to hedge their stock the first couple times, realize just how expensive that insurance really is. That cost of the put is very prohibitive. And so they want to find a way of offsetting some of that risk or that cost. And what they eventually learn is, well, I can sell a call against this position that offsets the price of the put, and what they end up with is a collar. And eventually they learn that a collar is essentially the same thing as a call spread. And when you wipe out all these lines of the long stock in yellow, the short call in red, and the long put in blue, what you end up with is a position that has the same P&L graph of a vertical spread. Your profits are maxed out, but your risk is a minimum. The short call is what limits your upside to make this thing act like a vertical call spread. Okay, so real simple. A collar is just the same thing as a long vertical spread, and it is the introduction to risk reversals. How most people would put in an order is they would already own a stock, and they would call up their broker and say, I want to buy a put and I want to sell a call simultaneously. And what they're entering is a risk reversal. So historically, buying a risk reversal implies that you're buying a put or put spread, and you're selling a call or a call spread to pay for it. And that was to hedge long stock. Now, that is really the genesis of how risk reversals came about. They just started calling it risk reversal because you're essentially reversing the risk or hedging the risk of your long stock. Then more advanced strategies came out with it. Instead of buying puts, a trader can go out and buy put spreads, or instead of selling a call, a trader can sell a call spread. So here what you see in the blue line is a long put and the yellow line is a short call. Instead of doing the naked options, turning it into vertical spread just simply changes the P&L graphs a little bit. And the net result becomes something that looks like this. And this is a long risk reversal that's being used to hedge the stock. If you're confused, don't worry about it. If there's probably most of you guys, because I know Tom's really dedicated to your guys' education, so most of you guys probably understand this part, no problem. If you're confused, just go back to the recording. But really, the definition of a long risk reversal is just simply a short delta position where you're buying the long put spread and selling the call spread. Or when you're selling the risk reversal, it's the opposite. Now, this is a little bit confusing because most of the time when we think of buying a position, we're thinking of buying deltas, getting long deltas. Here, it's the opposite. So you just have to get used to the nomenclature being a little bit confusing. But the light bulb should be going on at this point. Most of you guys probably already understand what I've talked to up to this point. So we're going to go into and transition into something a little bit more complicated in how we go about things at Strategy and what we use these risk reversals for, and a different way of looking at this whole thing. We're going to go from hedging a stock perspective into just ignoring any stock whatsoever, because stock is expensive, and use the risk reversal to create a directional position that's got better benefits than a stock does. And we like the risk reversals as a way of taking a directional position way better than buying a vertical spread, and you're going to see why. Most people are either going to want to get bullish or bearish, and then they go into either buying or selling stock, and then eventually they learn I could do the same thing with the vertical spread cheaper. But there's still some inherent problems with the vertical spread. Okay, now let's say you want to buy the 2405, 2410 call spread here. And you see that just going off of the ask prices, 640 and 5, it's going to cost us $1.40 debit. We go and look at the probability analysis and see what it would take for us to make our maximum on this trade, because it's the 2405, 2410 call spread. We need the stock to get above what? What price does the stock have to get above for us to make the maximum on this? It has to get above 2410. And by studying the probabilities of that occurring, we see that it's only got about a 27% chance of actually closing above 2410. So we're paying $1.40 to make $5 on something that only has a 27% chance of working out. Now, there are some people out there who are gifted with luck. Not me. Even though I was a floor trader, I don't know anything more about picking a stock's direction than anybody else here. As a matter of fact, I can make any stock go down. All I've got to do is buy it. And I can make any stock go up simply by selling it. So if this thing only has a 27% chance of me being worth its maximum at expiration, that leaves a very good probability that my $1.40 that I have invested in the trade is going to just vanish. What this call spread looks like graphed out is I've got a 73% chance of losing money at expiration. And for some reason, it feels like it's a 100% chance. The moment I buy a call spread, the stock goes down. I could have bought it 20, 30, 40 cents cheaper a minute later. It's amazing. So as a floor trader, I'm always thinking, I have $1.40 invested into this position. How can I get that $1.40 back, knowing it's probably going to evaporate? Well, you guys know that whenever you have money spent, the easiest way of getting money back is to sell something. When you sell something, you take money in. So why not go far out of the money, something that has a very good statistical chance of expiring worthless, and sell something on that side that will get you your $1.40 back? Namely, sell a put spread and collect the $1.40. And what that does is it changes our whole P&L risk. Not only does it reduce our cost of entry down to zero, we've added some risk, but our cost of entry is at zero, but our maximum profit is no longer $5 minus the $1.40 we spent. It goes up to $5, but we also have this giant area under the normal distribution curve where the stock usually closes. It goes to break even instead of a loss. In other words, how often do you guys see the market? Let's see. Let me try the drawing tools for the first time. Let's say the market's right about here. Start out with the market right here. We need the market to get all the way to the right, above 2810, to make maximum profit. But that's not how markets work. Typically, they'll just rattle around in a selected area and pretty much hover around the current price statistically. So I'm not going to mess with these drawing tools. I'll learn them a different time. But most of the time, we end up in what we call a dead zone. We don't get a huge move to the upside or downside. The stock pretty much just rattles around. Now, the great thing about this risk reversal is we had zero cost into the trade. And so we're no longer every single week or every single month donating that $1.40 per share to the markets. And yes, the market can sell off, but we have solutions to that too. We'll talk about later. Now, once we get into the risk reversal, then what? What happens then? Well, essentially, we're just doing the same thing as a long call spread or a long put spread. And the normal rules of the game apply. The market can go higher, it can stay flat, or go lower from there. Most of the time, though, you're going to find that the market, even though it rattles around, it goes up one day and you're feeling like, okay, now my call spread's going to make money. Then the next day it goes down and you're like, oh man, this thing's going to expire worthless. And again, most of the time you see that we end up in this giant void of a dead zone, but it's no harm, no foul. Even if we don't get all the way up to where the market needs to be for us to make the maximum on the vertical spread, it doesn't cost us anything. Instead of a $1.40 loss, we break even. And anybody who's ever bought a call spread hoping the market goes up, then watches the market go up, but not enough for that call spread to go in the money, knows the frustration of just owning a vertical spread. And like I said, we do a lot of these in our practical options tactics class every Wednesday. Okay. And I'm only bringing this up because we're going to give you guys all a free class for a month, which is 4 classes. We hold them every Wednesday night from 6 p.m. to 7:30 p.m. Chicago time. For you guys who are in different time zones, don't worry about it. We record it and we send you a link so you can watch it at your convenience. And we also send 2 to 5 updates with examples and explanations every single day. So 5 days a week, you'll see me going and showing you all my trades. Not just the winners, but all the losers too, because I think we learn just as much from losers as we do from the winners. And so people see 350 trades a year coming from me. All you guys are going to be getting the ability to get a free month of pod class from us. So and what we do is we start the account every year at $100,000 and we just see how much we can grow it. And I just show you the trades I'm doing. And here's a trade I did yesterday in Tesla, where we bought a butterfly at 400 center strike, and I'm going to start adjusting and playing with that in anticipation of the Tesla buyout. But you guys see every single trade, the winners and the losers, and you're going to get a free month trial. And I'll talk about that for a quick moment at the end of the class. Anyhow, here is a typical risk reversal where we're buying the call spread. We're buying the 20, 25, 20, 30 call spread. And you can see that this spread would normally cost $1.70. The $10.70 minus $9 is $1.70. Instead, what I did is I sold the 1960 55 put spread against it for $1.50, and now my entry cost is 20 cents instead of $1.70. And how it looks like on a P&L graph is just like this. And we rode this for a while. Then what? Well, obviously, when you go and look at this graph, where do we want the market to go? This is a bullish position. If you look at the left side of the graph, where the market's fallen, we do have some risk. And I know from my students, when they look at that left-hand side of the graph, they say, oh my God, we have $5,000 in risk. And they focus on the potential loss. And it gives them a little bit of fear and trepidation and nervousness. But think about it this way. If you had just bought the call spread for $1.70, you would have had $1,700 of risk to make $3,300. Here we have $5,000 of risk to make almost $5,000. So our risk is going up a little bit, but our profit potential is going up because we don't have the giant debit anymore. And most of the time, we don't have to worry about the downside risk that much, because most of the time, statistically, we're bouncing around between that short put spread and the long call spread. And that's not to say we ignore the possibility that we can lose money on this trade. The more you trade, the more you realize making money is more about focusing on getting rid of risk than creating opportunity. So we are worried about that $5,000 downside protection, and we do clean it up at a later moment. And there's different things we can do. Once we have that trade on, the first thing you're going to be asking is yourself, typically, is, what if we fall and I lose $5,000? What then? Well, that becomes a lot of people's focus, is that downside red area. But there's a couple things we can do. Now, to tell you guys I like broken wing butterflies would be an understatement. When I was on the trading floors, we only had one expiration a month. It was the third Friday of the month. And anyone who trades broken wing butterflies knows that expiration and the day before expiration, the day of expiration, that's like Christmas, okay? That's when these broken wing butterflies really open up, and there's huge profit potential. I used to joke on the trading floors. People would come in and ask me, Scott, how's your expiration looking? And I don't always say, all I need is a fat man and a tree, because it's Christmas. These broken wing butterflies work beautifully once they're on and expiration's approaching. And every expiration was like, I would work the whole month to set up for that expiration. Well, now we have 3 expirations a week in the SPX. So it's like, not only do we have Santa Claus coming in to visit, but we have elves showing up 3 times a week too. So very often I will take this downside risk and wait and turn it into a BWB. For example, here is a current option chain for Friday's options. And you'll see that if we were short the 28.25, 28.10 put spread, I'm short a $15 put spread. It's trading for 95 cents. So I can spend 95 cents to buy back and close out of that risk. Or I can do other things with it too. I can go out and maybe buy this put spread where I'd be buying this and selling this. And instead of spending 95 cents, I only have to spend 50 cents. And this long put spread will protect my short put spread. I can go and choose different strikes. I can go and buy this put spread where I'd buy this and sell this. Instead of spending 95 cents to close out the risk, I only have to spend 70 cents. So essentially, instead of closing it out, I spread it off, turn it into a form of a broken wing butterfly, save 25 cents, but then also have on a position that can make money as the market's collapsing. Now, there's a million different things we can do with the BWB to protect a risk reversal. And we do that in the pod class all the time. As a matter of fact, if any of you guys, sign up for the free class for a month, you're going to see plenty of times where I take a risk reversal and hedge it off. We've been long a lot of risk reversals the last couple of weeks, and for the last 2 days, I've been cleaning up all the downside. And I've been turning things into BWBs. I've been turning things into condors, turning things into iron condors. Let me show you something else we can do with this, or one of the other benefits of the risk reversal. Okay, it's such a pliable strategy that lends itself to all kinds of different follow-up trades that I really love, because it's really just massaging all the time. And once you have a great trade on and you can massage it and take money off the table, but leave something else on to make even more money, and then massage it again and take more money off the table and leave something on that can make even more money, it becomes just really a ratchet wrench of making profits. So we can turn it into BWBs. I would say the majority of the things we can do is, instead of a BWB, there's something else we can do, or there's some we can flip the trade over. And I love flipping the trade over. Let's say we entered into this bullish BWB, or excuse me, risk reversal, where we're long a call spread and short a put spread. Now we can buy a put spread that's closer to at the money than the one we sold. And we can sell a call spread further out of the money than the one we bought. Again, for zero debit or a slight credit. And let me just show you a couple examples of what we've done. Here would be, this was trade 11 this year. We're up to, I don't remember what, 200 right now. But trade 11, beginning of the year. Remember February, how volatile February was? In 2017, the market just took off to the upside. President Trump won the elections. Everybody thought the market was going to fall and crash if Trump had won. Instead, it went up almost every single day. The SPX went from under 1,800 to above 2,000 real fast. And as it was approaching 2,000, things got very wobbly. And we didn't want to have on, we wanted to create opportunity, but we didn't want to have on a lot of risk for any length of time. We wanted to clean up our risk as fast as we could. So we'd enter into a risk reversal and then flip it over. And what you see on this previous trade right here, it's just this. We got on a risk reversal, and then the market would move a little bit in our favor for 10, 15, 20 minutes, and we'd flip the trade over and end up with 2 little condors for maybe a $50, $100 debit that could make $5,000 if we closed within a $10 range. And then all we did for a lot of February when the market was going really crazy is just put on as many of these as we could all over the place, hoping that when the market finally slowed down and that peel, the little P on the roulette wheel slowed down to indicate what number it was eventually going to land on, we had a call or a put trade on that would blow up big and make a good profit. Eventually, here's trade number 7. We just kept massaging it. Remember I said we would massage it. We'd take the risk reversal, flip it over, have some risk to the downside, turn it into a BWB. Then as the market went down, we'd sell another put spread, buy a call spread. When the market would go up, we'd reverse it. We'd sell a call spread and buy a put spread. In that center area, we would just sit there and try to get the walls between 28.95. Let's try to get a drawing in there real quick. The wall between here and here, we just kept massaging. Here you see 7. That means trade number 7. There's A, then we did a B, then part C, and we kept adding to a lot of these and get a part D, which would take our wall closer, and we would just keep closing in, get this little dead zone tighter and tighter, so that eventually, we'll call this the 1 SD band, and over here the 1 plus 1 SD band. We wanted everything in an area. Well, we would try to get a position on where anything inside the SD bands eventually was just a profit. Then as the market would move, the SD bands would move, and we would just move everything to the right or the left as the market indicated. And we just kept massaging this and massaging it. We would do, as the market would move, start over here. And if the market went down, we try to create it there. So that essentially almost any possible closing price had a trade on that could end up making us money. Pretty much we just waited until expiration for it to figure out, for the markets to figure out if it wanted to close and give us close right here and give us a $4,800 profit, or close right here and give us a $2,000 profit. We were just waiting to see where the closing price was going to be. Now, trade 19. We did it. Trade 19. Here's another example. We did it with $50 wide separation between the call spread and the put spread. So the call spread was $15 or $25, $30 out of the money, and the put spread was $10, $15, $20, $25 out of the money. When you put the positions together, you had on a position that really had a lot of deltas going back and forth that you could play with. We've done them with $100 separation between the strikes. I've done them with $150 separation between the strikes, depending on what's going on in the markets and how volatile the markets are. Now that begs the question, what strikes do I use? And that depends on a lot of things. Okay, it depends on how far out in time you go, how volatile the markets are, etc. Okay, but there's a lot of different ways of playing this. Right now, I think we're have risk reversals on in 3 different expirations, and I'm about to add a 4th one today. And that's why it requires such a big, thick book to talk about it, because there's just so many different possibilities at which one can manipulate these things and make a custom position to really design things around your opinions. You may be of the thought that we're going to keep going higher, but we're not going to get above 2,900 because there will be resistance there in the SPX. You can do these things in Facebook and say, look, we can go up to maybe 215 again, but we're not going to go any higher because that's where we fell from the earnings. You can go into Tesla, and I'm going to probably enter into one in Tesla by the end of the day, to take advantage of the possibility that Elon Musk really is going to be trying to take the company private. And instead of buying a call spread that'll cost me $2 for a $5 call spread, why not enter into a position that has 0 cost of entry and affords itself the ability to flip over in a second once I get a little bit of movement in my direction and have on a riskless trade? Okay. Great question came in. Is this strategy used on indexes or on stocks with, low ATR? The great thing about this strategy is it lends itself to any product you want. I've done them in crude oil when crude oil earlier this year was going nuts. We do a lot in different equities. Those who like the BWB know that one of the downsides of the BWB is they're difficult to get in certain stocks. We all may have our favorite equity we like to play. Mine is Apple. I've done a lot with Tesla this year, but my favorite stock is Apple. It's one of those stocks that I feel I kind of know. There's some stocks that confuse the hell out of me. Every time it starts going up, I think, okay, here, we're going to break out to the upside, and then it falls apart. And it just frustrates me. As soon as I think I understand it, it stops making sense again. Apple kind of makes sense. And the great thing about Apple is right now we have this bias where Tim Cook is buying shares back and Warren Buffett is accumulating a position in Apple. When you have Apple itself buying shares and Warren Buffett buying shares, you know that there's a limited amount of downside to this stock, and you can take advantage of it. I love it. But I would say the majority, Rubik, to answer your question, is the majority of the positions we play risk reversals in my pod class is in the SPX or the SPY or in the NASDAQ, in the indexes. And the reason for that is we like to hedge off the risk quickly. And so when we're into a directional risk reversal, we buy deltas by buying a call spread and selling a put spread because the market sold off and we think it's going to bounce. We can hedge it off quickly. We turn our call spread into a condor. We turn our put spread into a condor. And if we get a big enough put condor on, it acts as a free hedge to our portfolio. So instead of carrying long deltas and having to worry about buying puts or put spreads in case the market crashes, I have on a big wide condor that I got into for free. And it also, if we add a lot of BWBs to the trade or our position, you always run the risk that the market falls too much and the BWB is going to go against you. Well, the free put condors we got into from the risk reversal hedge off any risk from the BWBs. And so we got this giant bearish position on indirectly. For example, let's talk about something completely different right now, and it'll make sense what I'm just said. Okay, now I don't know how that today sign got up because this was not today. This was a while ago, but this was a great example, and that's the only reason I use it, because it's a real garden variety example. So we're looking at the 2105, 2115 call spread. How wide is that? That's $10 wide. And then we sell the 2045, 2040 put spread against it, and that's only $5 wide. And this is what we call an advanced risk reversal. It's advanced because the size of the call spread and the size of the put spread are different, but we use it in a way that becomes gamma scalping almost. And that's why we call the risk reversals, or the advanced risk reversals, the poor man's gamma scalping. Let's say we enter into this bullish position where we're long a $10 call spread, and we sell a $5 put spread to lower our costs. You can see that this call spread, had we bought it by itself, would cost us $3, $8.10 minus $5.10. But because we sold a put spread, we cut our risk down to $1.70. Once the market goes in our direction, we can flip this trade from bullish to bearish and back and forth. It's very flexible. Okay, we enter into this trade for $1.70. We filled on our long deltas. This was an actual trade. We bought this for $1.70, right when the market was there. We had no idea where the market was going to go. But later on that day, the market went higher. Whoops. And you see at the bottom, we moved our strikes higher. Let me pull out my drawing tools. This is time period number 1 at the top. Time period 2, the market bounced higher that day. And you see that we bought the 2105, 2115 call spread. Later in the day, we could sell the 2115, 2125 call spread. Again, both of them $10 wide. And then on the put side, we had a risk here because we sold the higher strike put. So we sold the put spread. Now we went in and could buy the 2055, 2045 put spread. That's $10 wide. We sold a $5 put spread. Listen to this, guys. I know after a while you tend to drift off, but pay attention for 1 second. Look at the beauty of this. This is how market makers on the floor think. I've got $5 of risk here. I sold this. It's $5 wide. I can lose $5. But now I go higher strikes and I buy a $10 put spread. So if I'm long a $10 put spread and short a $5 put spread, what is my net on that? I'm long an extra $5 put spread at a higher strike than the one I'm short. And you can see that this, remember, this was a $1.70 debit up here. and now we take in $1.70 credit. What is our net cost on this trade if we got $1.70 going out and $1.70 coming in? It cancels each other out. And so we're into this whole trade for $0. This was a real trade we did. And what's the resulting position? This is what we hit on. Look at the 0 line. What's the most we can lose on this trade? 0. Now we have on this wide butterfly to the upside with calls on the right-hand side. And on the downside, we have a butterfly with an extra $5 put spread. Now, if you're bearish, just keep the trade like this. That's fine. If you're bearish, what's better than a free put spread? But most of the time, I don't have an opinion on the market. I'm not smart enough to be able to predict the market. I have opinions just like everybody else. We're in the longest running bull market in the history of the stock markets right now. Interest rates are still low, and that's a determining factor. But we also have a lot of negatives going on out there. We have our president trying to change the whole order of the world's trade and putting tariffs on people. It may work out. It may blow up and become a giant trade war where everybody loses 2 arms and the stock market goes down. We don't know how this is going to play out. President Trump thinks that we're in the strongest position and people are going to fold. Because we have a deficit with every country out there, he feels that everybody has got to bend over to and grab their ankles for us. President Xi of China is a very strong-willed person too. And he's president for life. He can't get fired. He may just tell Donald Trump, you know what, let's go to the mattresses. And all of a sudden we got a giant trade war that Trump thought China would blink. China got stubborn and said, I'm not going to take orders from America. And everyone's taxing the heck out of everyone to where companies suffer and stock prices go down, which drags the stock market down. If your opinion of these trade tariffs are going to end up bearish, what's better to have on than something you don't have any money into that results in a free put spread? Or, personally, I'm not getting into that opinion. Every time I have an opinion, the market does something to prove to me I'm not that smart. And what happens instead? Nothing happens or the market goes higher. So, but I still have this profit potential to the downside that I can use for something else. Why not put a broken wing butterfly in here? And you guys know the graph of a broken wing butterfly. It looks like this. And then we go into the red loss area. Most of the time, because of the physics of the broken wing butterfly, as long as we manage it well, we don't have to really worry about that downside loss potential, even though it really exists. But now we really don't have to worry about it, because any loss we have on the BWB down here is offset by this free put spread we got in the advanced risk reversal. And that's what's so great about these risk reversals and advanced risk reversals, and why, like I said at the beginning of the class, 20% of all my trades I do in the pot class, maybe even more, are risk reversals. And I want to start playing Tesla today because of all the opportunity that's in there right now with Elon Musk talking about taking this thing private, that there's going to be so much opportunity. I want to have on some positions that could benefit from said opportunity and the increased volatility. The back month calls we had on yesterday on a 50 vol, by the end of the day, we're trading on a 66 implied volatility. Volatility is going up there. There's opportunity to be made. And having a risk reversal on with maybe a free upside call or a free upside put spread, you got to love it. Free opportunity is what floor traders look for, live for, dream about. You know, when I was on the trading floors, I didn't dream about women at night. I dreamed about a position that looked like this every single month. Unfortunately, we only had expirations once a month back then. So the advanced risk reversal, you know, that I cleaned up earlier or hedged on this previous slide, it was not a timing thing. It was a hedge at resistance. I was just playing technical numbers on this particular day. When we got to what was 2080 at that day was huge resistance. When we bounced from 2072 to 2080, I just flipped it and said, you know what? There's resistance here. Now, it wasn't really resistance because we kept going higher from there. So, but I didn't care. What I ended up with is a trade that looked like this. And I said, okay, next. Now, I don't know, Tom, how sophisticated your group is. I'm sure you've done a great job getting them to where they can look at this graph and know this is better than like a genie coming out of a lantern.
Oh yeah, this is pretty obvious to everyone here.
But if I could get one of these on a day.
Oh yeah, wouldn't that be great?
Or one every couple days. You know, even in a part-time trading gig, which is probably 30% of my students aren't looking to do this 7 hours a day. It's just a part-time thing to them. They just wait until we send out a text to their phones every time we send out an update, and they read the text and say, oh, Scott's getting long right here. This is what he's doing. Let me see what he's doing and why. And it may spark some interest on them. Oh, you know what? If he thinks the stock market's going higher, maybe that's going to drag my Facebook higher or my Amazon higher. Maybe this is a good place to get into a risk reversal in Amazon. They're not copying my trades, but they use it to like spark their own creative juices.
And for the timing.
And for the timing. And then when we get to resistance, or you know how it is, Tom, you're good at this. You can tell by just watching the market when it's starting to run out of steam. And it's like, well, you know what? This rally higher just is puttering out. I could get greedy, but you know what? I'm just going to get hedged. Or when the market's selling off so hard, you're like, you know what? This is crazy. I mean, Facebook, you know, is down 20% in a day, and then the next day it's down another 5%. Or Chipotle, 2 people are getting sick by eating a Chipotle, and the stock fell $50. This is ridiculous. You can sense when things are overdone, and you use it as an entry point. Sometimes you're wrong, but the great thing about the risk reversals are so forgiving. And often when the market falls, boom, it goes out the other way, right? It becomes like a Newtonian cradle. But this is what we try to get on all the time, is graphs that look like this. And sometimes we miss and we've got a little bit of a debit into it. And sometimes we screw up completely. And I just time everything bad. And if I got risk to the downside, I said, you know what? I've got risk to the downside. I didn't think the market was going to go down, but it is. Okay. I'm wrong, which, like a quarter, happens about 50% of the time. 50% of the time. I'll just say, hey, you know what? I got risk to the downside. I don't want this. I'm going to take the short put spread, buy a long put spread at a higher strike, turn this into a broken wing butterfly. Spread some of this risk off and manage that part of it. This is what we have on currently right now, just in the last couple days. We put this on. As I was getting concerned that we're going to go back to the all-time highs of, the 2870 area in the SPX. But when I was cleaning up the call side, it afforded me to get some downside protection. Now, could I do 10 BWBs with $5 of risk from this point on and not have to worry about the downside? Yeah, because even though I don't think the market's going down, I've got this opportunity that I can layer a BWB into it. Here's another trade we did. Look at the dates. 8-2. This is a very slow moving trade we got into. I just said, look, we're going to put on a trade. It's going to be a real slow moving trade where we're just going to assume we're not watching the market every single minute. I'm going to go out and buy 2840, 45 call spread, sell the 2745, 2740 put spread against it. So it's like $95 separation between the call spread and the put spread. $95. That's like almost 1,000 Dow points. That was the entry point on the second. We bounced a little bit on the second. I said, you know what? I'm going to take half of it off. I bought 10 call spreads. I'm going to sell 5 further out of the money. Here, I'll pull up the drawing tools. That'll help. Started out buying 10 call spreads. Later on that same day, I sold 5 call spreads at a higher strike. So I'm basically building a call condor. And then I'm going to take that money, which you can see right here was $1 credit I took in from the sale of call spread. And I will buy 5 put spreads for 90 cents to hedge my short put spread. Now I'm short a $10 put spread at the $10 wide put spread at the 27.45.40 put spread. Whoops, I made a mistake here. This is 85. Strike at the 27.98, but the 27.85 put spread. And I bought a $5 put spread higher. In other words, I'm long the 27.90, 85 put spread. I bought this 5 times. And then my short spread is at the 45.40 strike. So if I'm long 5 up here and short 10 down here, what do I have on? An unbalanced condor with $40 separation, which is about 400 Dow points separation, which your people probably know that the unbalanced condor acts very similar to the broken wing butterfly. Okay, now somebody just asked a question. It says, please explain how does this require margin accumulate as you add credit spreads? They're going to cancel each other out. Almost always, and this is the beautiful thing, Rubik. This is the beautiful thing about these risk reversals and advanced risk reversals. When I started this trade out, I bought a call spread. And I sold a put spread. The sale of a put spread. Okay. I sold 10 put spreads, $5 wide, and about 10 call spreads, $5 wide. On the call spread, all that is going to charge me, because I'm buying it, is the net debit. But most of that debit was offset by the short put spread. And so the biggest concern was the short put spread, or $5 of risk on the short 45-40 put spread. Now pay attention, because it may get a little bit confusing, but it's beautiful. I'm short a $5 wide put spread 10 times. That's 5,000 in margin. And the reason I do it this size, 10 contracts, is because in the pot class, we start with 100,000 at the beginning of the year. And I don't ever, the rule we have in pot is I don't ever risk more than 5% of the account on any one given trade. We talk about money management a lot. We talk about a million different topics. One of the things is money management. Our rule in pot class is never to risk more than 5% on any single trade. If I have $5,000 of risk on a 100,000 account, that's $5,000. Now the account is above 190,000 by August. So I could almost go up to $9,000 of risk per trade, but I'm still keeping it at about 5,000. But here's the great thing. We have $5,000 of margin. And we could have done one contract and had $500 of margin on it. But what happens? On the second trade, I'm buying a put spread. I'm buying a put spread closer to at the money. So I only did 5 contracts of it. So that can make $2,500. Versus the 5,000 of risk on the short spread. Depending on who your broker is, I know with Thinkorswim, they group these together, and they'll consider this 5 condors. I started out with short 10 put spreads, which is $5,000 in margin. Then I bought 5 put spreads at a higher strike. So they think I have on 5 condors and 5 short put spreads, which is $2,500. So really, every adjustment we make, Rubik, the margin starts out with $5,000. It then went down to $2,500. And right now, our margin on this trade is $600. It's gone from $5,000 to $600. The purpose of what we teach in pot class is to reduce risk, reduce margin. You know you're reducing risk if your margin's going down, in most cases. Because yesterday, we made another adjustment, or 2 days ago, excuse me, 2 days ago, we made another adjustment by buying another $5 put spread, even higher, that could make $2,500 because it was a $5 put spread on 5 contracts. So we're long 5 put spreads we're long 5 put spreads here, and we're short 10 put spreads here. What do we have on? A medium-sized condor and a big long condor. We took our short put spread and made it into a wide long condor. And that's why you see from here to here, nothing but profit potential, because it's now a condor. And you guys are familiar with the graph of a condor, I'm sure. And that's the beauty, is the margin kept going down, and now our margin is $600. And what's my goal? My goal is, and Robert, who's another one of our traders, he was a student of mine. Didn't know anything when he came to me. He just didn't know what a call or a put was. And he became so good that Thinkorswim was watching his account. And Tom Sosnoff, the guy who started Thinkorswim with Scott Sheridan and a couple other guys that I knew from the OEX bit, approached him and said, hey, we as Thinkorswim's firm have an account we manage. We manage people's money. Will you manage the account for us? So Robert started managing Thinkorswim's account. Then he was approached by Merrill Lynch and then started managing Merrill Lynch's derivatives account. He was managing, I don't know, $200, $300 million in options for Merrill Lynch. And now, you know, he's in his early 50s and has enough money. He doesn't want to be bothered with the stress. So now he just plays with the stock stuff by himself with his own money. And he helps teach classes when I have classes in Maui or classes in Italy. He sometimes finds that he's in a giving enough mood to spend 2 weeks in Maui to help me teach a class for a couple days. So now, you know, he helps out a little bit, but my job is the facilitator of the pot classes to say, okay, we have gone from 5,000 in margin to 2,500 in margin to 600 in margin. How can I get my margin down to 0? How can I raise up all these lines? And it's going to be a really lousy job drawing, but how can I raise this whole thing up another $600 to where I have this whole trade on for no risk, only opportunity, and no margin? That's why, guys, when you saw, let me go back a few slides real quick because it's sort of a distraction, but I want to answer people's questions. Rubik had a question I want to answer as clearly as possible. We have on, I don't know, 7, 8, 9 different names right now, and 10 lots and everything. That's at least 10 lots. Gets even bigger and bigger as we get one trade on, we add another one. But look, started out with 100 grand, and now we have $165,000 in option buying power, meaning we're using less than $30,000. We're using less than $30,000 in money right now. Because every time we put risk on, the next thing we do is try to figure out how to reduce that risk. I hate using margin. Why? It not only ties your hands, but is an indication of how much you can lose. Then another question just came in. How long do we keep this on? Do we keep it on till expiration? No. That's a great question. It really depends on a lot of things. I'm constantly rotating the inventory. Okay, as we get closer and closer to expiration, I want this on. I mean, if you got a trade on, let me ask you this. Let me ask you the question, so maybe you can answer it yourself. If you've got a trade on that looks like this, guys, one second. How many expirations do you want this on? Do you want it just one time, or would you like it on this week? How I look at it is this, and I'm going to hurry up because I know we're running low on time, but let's say the market's right here, and we had this trade on. If the market sits here, this shows that I can lose, I don't know, 150 bucks. I don't want it to lose 150 bucks. I want it to close right here or right here on expiration, right? Everyone can see that. The ideal places to close on expiration are between here and here, or here and here. Now, the market is right here, let's just call it. So because of Murphy's Law, guess what? Guess what's going to happen? Let's say there's 5 days to expiration. We know for the next 5 days, the market's just going to rattle back and forth to frustrate us, right? Instead of going and parking right here or right here like we want, it's going to frustrate us. The market's going to do whatever it can to frustrate you. That's what trading is, and it doesn't exempt me more than it does anybody else. But what if I have this on in the 3 days, the 10 days, the 15 days, the 30 days to expiration? Eventually, the market's going to move to one of these areas to make us our money. It can't help it, okay? It can screw us 1 time in a row, 2 times in a row, 3 times in a row, but it can't nail us every time. One of these days, the market's going to drift lower or it's going to drift higher, and we're going to make money. And this is the great thing about the risk reversals, right? We've taken all the money out of the trade. Even if it closes right here and expires worthless, we're going to lose $150. But let's say you bought a call spread 10 times for $1.50. That's going to put $1,500 out. And now you lose $1,500 because the market didn't go anywhere. Okay, we're reversing the risk out of the trade in several different ways. One of which is we've taken $1,500 trade by buying a call spread and having a big debit and bringing it down to $150. Now, not all the time can I get this. I'm not, David Copperfield. I can't always get every single dollar of risk out of the trade. But if I get it from $1,500 down to $150, I can be wrong 9 times as many times before I start losing money. Now, and the great thing about these risk reversals is just how pliable they are. This is, like I said, this is what we were looking at last. We did an update on the 6th, which was 2 days ago, and got the trade down to here. Now we have $600 of risk on, but look at the range on this, guys. As the market drifts between 2,900 and 2,740, that's 160 SPX points. I don't know, if you don't trade the SPX, you don't quite have an appreciation of how wide that is. But 160 SPX points is 1,600 Dow points equivalent. And even if we sit in the middle, guess what? Time decay with this little tight range right here in the middle is occurring every day. It's between 28.15 and 28.40 we lose money. Well, guys, that's 25 points. That's minuscule. We move 25 points almost every day in the SPX. It's going to scare people to the upside or scare people to the downside. If you're familiar with these risk graphs, look at that purple line. That's the profit we have into the trade right now. Every day, closer to expiration, that line goes up a little bit because of time decay. The next day, it'll be even higher. So Rubik, to answer your question, do I keep it on until expiration? Well, if the market's right here, I'll push my luck. If it gets here and there's only a day to go to expiration, this trade is still going to retain some value, and I will manage that trade like I would any other trade and try to ascertain what the probability of it going out worthless is. I could make $4 on the trade, or $4.40 on the trade. Okay, that's max profit. I have 60 cents into the trade, and it's trading for $2 right now. You can see close to $2. Do I just close it out at $2 and take a $1.40 profit? Or do I push my luck and try to make the full $4.40? Typically, what we'll do is we'll sell half of the trade out, which brings in $1,000. Because we have $600 or 60 cents into the trade. Now we have the whole thing on for a 40-cent credit. That brings us up to the $400 line. And we'll manage it that way. We'll try to get it so that no matter what happens, we make some money, even though we can't make as much as we once could. We've taken all the risk out of the trade. And it's the risk, guys, that we worry more about as traders than the opportunity. Opportunities always take care of themselves if you get rid of the risk. But you'll see that the book, like my BWB book, if any of you guys ever read that, every book I write has step-by-step criteria. So it's a cookbook. It just doesn't explain the strategy. You buy a call, you sell a call at a higher strike, you got a call spread. Next, what's a put spread? You buy a put, sell a put at a lower strike, you got a put spread. That's how most books are. They don't tell you. They tell you what every strategy is, but they don't tell you how to put the odds in your favor. Every book I've ever written has criteria in it that's based on probabilities and statistics to put the odds in your favor. It doesn't mean it. Every BWB you do is going to make money, but it does put the odds in your favor, and it explains how we on the trading floor looked at it as floor traders. Okay, now I want to thank everybody on behalf of my company, and this is my team of people, for giving me the opportunity to speak tonight. I also said that anybody listening in gets one free month of pot. Okay, every Wednesday night from 6 p.m. to about 7:30 p.m. We have a pot class where we teach for an hour and a half, just like I taught you this. And then we do examples based on what was taught that week. So the next day, which will be Thursday, I'll find an example. We'll follow that trade based on what we learned. And it's a free gift to you guys. All you have to do is write a letter, a quick email to admin@stratagemtrade.com, and one of my people will get you enrolled. We usually charge $300 a month for it. So it's a great deal. You got nothing to lose. But if you want to try out our pot class, you can. Just a caveat. I do whatever my students want me to do. The pot class is not a dictatorship. It's the ultimate in democracy. We take every student's suggestions of what they want to learn and incorporate it into pot based on popularity. Well, one of the things that people said is we want to learn while the market is going on. I've got a real job. I can't, like, during market hours, can't have pot class every single week during trading hours. My boss just won't go for it. But maybe once a month. So we started adding a pot class once a month during trading hours. We start a half an hour before the open, and then I find trades or teach something based on the market moving. And so we've gone from every time at 7 p.m. Eastern to once a month. We have it at 9 a.m. Eastern, but they're recorded. So if you can't attend, it's no big deal. Everything's recorded. And along with that comes all the updates. Again, 2 to 5 updates a day on whatever I'm doing. I'm putting the trades in. We're managing it. You get a list of every trade we do, so you can see that I have as many losing trades as you guys do. The worst trader listening today has the same amount of losing trades that I do. The difference is all we do differently at Stratagem is what I used to do and all my friends did on the trading floor, which is to reduce that risk, just like I showed you in the risk reversals. We started out with 5,000 at risk. That's too much. Let's wind it down to 2,500 at risk. Now let's take it down to 1,600 at risk. And that 600 at risk or $400 at risk, if the market looks like it's going to collapse, I take my short put spreads and I turn it into a broken wing butterfly, or I turn it into an unbalanced condor. And we use the normal distribution curve or the option normal time premium curve that contracts and gets tighter as we get closer to expiration. We use that to our benefit. So again, everybody who's interested in any of our products, like the Advanced Risk Reversal book, Tom got you guys.
I got my copy of that book a few days ago, and I've started reading it. It's really well written and easy to follow, and I'm looking forward to finishing the whole thing. It's a good book.
Thanks, Tom. You know what the ironic thing is in school I was a science major. I hated subjective classes where the student who brings the teacher an apple gets the good grade, even though he's like licking the window of the bus on the ride in every day. You wouldn't let this guy cut your lawn, but because he's like the teacher's pet, he gets the A. And the subjective jerk that I am gets a better paper in and gets a C on it. And I hated reading books that my teachers assigned because I don't care about Beowulf or, you know.
Right.
Chaucer drove me nuts, even though it's kind of an interesting story. The Old English drove me nuts. I didn't want to read literature and then give my opinion on it. And it was too subjective. And I have a type A personality that like really rubbed a lot of teachers the wrong way, especially when like I was hitting them with spitballs and stuff. I was a problem child. But when you have a science major, math, they can't say when you got the answers minus 4i and the answer is minus 4i, they can't say you're a jerk, you should have done plus 2. Right? It was more clean cut. So I became a science major. So I never had to write a paper. I hated writing papers. I said, I'm never, ever going to write ever again. I'm never going to take an English class in college. And the funny thing is, guess what I do for a living right now? I've written 16 textbooks. You know, it's like what God gave me while I was busy making other plans. You hate writing? Okay, you're going to be an author. So it's kind of ironic that I write so many books, given that how much I hated writing as a kid. But now it's I don't consider myself a good writer, but I think I just take the trading and break it down into as remedial of a format that's understandable as possible. I just write these textbooks like I'm trying to teach it to my grandkids.
That's the best way.
You know, I mean, I'm not going to sit there and There's some people who write textbooks. You know, there's some books on trading out there I've read that are like trying to. I don't think they're trying to teach anything. I think they're just trying to impress you with how much knowledge they have. But that does you no good. I mean, half of the option books I've owned, I've never gotten past page 20 because they're like, they put me to sleep, and there's no practical functioning. I don't care if you think have a third grade writing level. I just want you to know how to trade. That's the objective. If you're a better trader, that's the goal. So anyhow,
We had a couple questions before we leave.
okay. Yeah, I only see 3 up here, so I don't know if I'm.
I think you're looking at the Q&A. There's also a chat.
Oh, okay. Let me see. I was looking at the wrong thing, huh? Okay, let me find chat.
Like Bodan asked, will you cover the Tesla trade in this evening's pot session?
Oh, there's the chat. Okay, hold on a second. There we go. I'm sorry, Tom.
Oh, no problem.
I didn't see it. I thought.
Yeah, we got most of it, just down to the
Okay.
last couple.
Okay. Steve, One Strategy for All Markets. Is that my BWB book? Correct.
And Bodan was on the floor in Chicago. I don't know if you ran into him or not.
Who is?
Bodan. Fedori? Will you cover the Tesla trade? That's from Bodan. He was on the floor.
I don't see any Bowden question here. Or is that a question from you?
No, that's to everyone. About the Tesla trade. It's a little bit underneath, past that BWD book question.
Will you cover Tesla trade in this evening's pod class?
Yeah, that's the one.
Oh, okay. Yeah, Bowden, I'm sorry. If you were on the floor, I'd probably recognize your name or your badge. Okay. I'd recognize your face or your badge. I was down there from 85 to 96, 97-ish. And primarily on the SIBO floor. I did spend some time on the Merck floor and some time on the Board of Trade floor, but after the crash in 87, the options on the Merck floor dried up to 0. I mean, nobody traded options after the crash in 87. Volatility was on the 200%, and anyone who was still alive didn't want to do anything. And so the volume just dried up, but skyrocketed on the SIBO floor. And so I moved, a couple blocks over from the Merck to the CBOE and just spent the rest of my life there. But will I cover Tesla tonight? Yes, I will.
Oh, and he says he was FST on the CME and he traded S&P and the euro dollar.
Oh, you traded the euro, so you must be a big, tall guy, because that pit was crazy. When the euros first came out, the traders and the brokers were hiring ex-football players to stand near them as clerks to buffer the pushing and the shoving. I don't remember FST on the CME. I was so you traded S&Ps in euros. I was trading the S&P options, which was right outside the SP futures pit, right by the break room. We were that little pit that everybody walked by wondering what the heck we were doing. Another question: One Strategy for All Markets. What's different? Yeah, it was all DePaul's basketball players, and you're right. They just hired I'm 6 feet tall. On the SIBO floor, I was like a decent size. I'd go in the Euro pit, and I couldn't see anything but chests. They just hired people not based on IQ, but by height and weight. It was crazy. It was like a mosh pit. You once bought the BWB book from Random Walks, not allowed to print it out. You know what, Dorian? The problem is, when I left Random Walk, I started it with a partner, and we just had greatly divergent opinions on what an education company is. I looked at an education company as a company that provides education, and if you do the best job at educating and people are profitable, they're going to buy everything you got. I know me, if I bought a book, implemented the book, and started making money, I'm going to buy every book that company's got. It's a no-brainer. My partner was looking at the business as a business, not as an education company, and she and I'm not criticizing her because she basically took the Optionetics model, and Optionetics was making 50, 100 million a year, and she said, that's what I want, and worried more about profits. Now, when you have ebooks, it doesn't cost you anything. Our books are so expensive because we print them hardcover. I mean, it's crazy. I think we spend about $70 on printing per book because it's on heavy paper. It's a hardcover. I mean, it's glossy. It's like a school textbook. Our students tell us that they understand better on paper and good quality, non-reflective paper. And so we spend a fortune. I know that my old company just went to ebooks because it doesn't cost them anything to print. I don't know what I spend in printing a year, but it's crazy. I mean, it's absolutely crazy. When you buy 100 books, they charge you, $6,000. You're like, for 100 books in printing, it's like you're almost tempted to go to ebooks too, to save $6,000. But
Well,
we're never going to
I've got
skip
it in my hand. It feels good. It's a solid book.
It doesn't look like it would cost $60, $70 to print, though, right? I mean, you go to Barnes and Nobles and buy the same book, and it costs like $7. But
Well, I'm just glad the customs guys didn't open it up and look at it too carefully because it says $4.99 on there. But
oh, really? You know what? I'll take that off because when we were in the States, it's not a big deal. But now I'm like getting huge in Italy. I'm doing a lot of classes in Italy. And that's going to become an issue. So whoever's in Stratagem right now, listening in, take that $4.99 off so that we don't have customs issues. Thanks for pointing that out, Tom. I didn't even think about that. But yeah, that is my book. We're reprinting it right now with more material in it and updating because that book was mostly geared towards the OEX, which is now pretty much a dead product. They still trade it, but there's no volume in it. And we're primarily doing things in equities and big equities like Amazon or the SPX. And so we're adding more to it, and it'll be another couple of weeks and another version of once the second version of that will be coming out with updates for today's markets, not when the book was written.
I guess there was one more question. Steve asked, how is the Advanced Risk Reversal book different from the other book, One Strategy for All Markets?
Well, it's the same type of format. Okay, when I started writing books, I just listened to everybody. What do you want? Okay, what is everybody doing right now that's not working to what it would take for you to learn the strategy? And they said, well, it just tells us a strategy, but not what to do with it. So every book I've ever written has criteria. It's just like the One Strategy for All Markets or BWB book, except for it covers two strategies in there, risk reversals and advanced risk reversals. And then, Tom, when you get later in the book, you're going to learn about how you can take these advanced risk reversals and just keep flipping them back and forth as in choppy markets to where you're basically gamma scalping. But without the problem with gamma scalping is you got to own options which have theta, and you're trying to take more out of the market than time decay is eating up. The great thing is with these things, time decay is actually working in your favor. Instead of you paying time decay, you're collecting time decay. And so it's the same sort of thing as the BWB or One Strategy book, but just a different strategy. Instead of broken wing butterflies, it is the risk reversal that you learned here. And then more things like gamma scalping these risk reversals that I didn't cover today.
And then one last question from Rubik: when entering position, what's the DTE that you used?
It depends on which strategy we were discussing. Right now, let me see if I can pull this over. Okay, I'll just, in just full disclosure, I don't ever hide anything. But here, this was 10 contracts on the call side. This expires in 5 days. Okay, this is just one of the BWB, or excuse me, risk reversals we had on. We had on a long $10, and then we sold a $5 or a $5 against it. Then we turned it into a $10. This we played with a lot, actually. Okay, it's almost impossible by looking at it what it started out as, but really, it started out as just a garden variety little risk reversal where we were long a $10 call spread 10 times. I sold half of it out on the open right before the class started. But let me scroll. You'll see the put side of it. Okay, there's the put side of it. Okay. This started out as just a risk reversal where I sold the $10 put spread. Or excuse me, a $5 put spread 10 times. I had 10 contracts of a call spread. Then, as the market went up, I sold 5 contracts of a call spread and used that money to pay for 5 contracts of a put spread to hedge my short put spreads, reduce my risk, reduce my margin. Now, we have on in the 3 days for Friday, the same sort of thing. Well, now it's 2 days. And I sold out half of this morning. Okay, you see we have 10 contracts. We started out in first day selling. And we could have started the other way. We could have got a bearish position on, bought a put spread and sold a call spread to pay for the put spread. And just we're in a bullish trend, so I'm using it as a bullish tool. But I started out with this. Long 10 call spreads and short 10 put spreads to pay for it. Then later on, the market moved a little bit. I bought 10 put spreads to protect the short call put spreads. That became a condor, no risk. And I sold out of 5 call spreads, excuse me, 10 call spreads, $5 wide. To pay for this. So what did I have on? This is the advanced one. This is not a regular risk reversal. This is an advanced one. So what I was left with is a $10 long and a short 5 further out of the money. So if the market went through all the strikes, Tom, how much can I make on the upside?
Looks like, let's see, your long 5, short 5. That the red lines, is that plus or minus on
Well,
the
here,
28.55
I asked a
strike?
confusing
Oh, there it
question.
is. Yeah.
What I ended up with is a put condor. Okay. And then I had on a $10 call spread and a short $5 call spread further out of the money. So I had on this free $5 call spread. Right? If this is the 0 line right here. Oh, I'll change colors. And it's so hard to draw with the mouse. But okay, we'll call this the 0 line. I had really like a condor with a free $5 call spread. So if the market went to infinity, no matter what, I made $5 on 10 contracts for $5,000. I wanted a very, very bullish position. Now, with the market at 25.58 or 28.58, the market's pretty much with Friday expiration right between these.
And do you know when you put that, did the initial trade for that position?
I can pull it up. Hold on a second. 1 second. Get rid of all these drawings. This is, oh, Glenda. There's somebody who said they're trying to buy the book online. They have different billing information and shipping information. They said they can't do that on the website. Dorian, just do me a favor and email the office and they'll be happy to take care of it. Okay,
Just put that in the chat. Yep.
Yeah, just email at admin@strategytrade.com. And this is a common thing. We don't make it easy like Amazon does to ship to different addresses, because even though we have a lot of people do it, because there's always like a credit card problem where you have a different shipping address than on the credit card, and then it gets kicked out and people get frustrated. So it's just easier for people to contact the office. But let me see, August 10th expiration, right here's the trade. We started this on 7/19, 7/25 we hedged it. And then today, what I did is there was 10 of these positions on the call side. The put side still has 10, but on the call side, right over here, this was 10, long 10, short 10, short 10, long 10, up until about a half an hour before the class started today. And I sold, you can see, I'll just show you, I sold why is this not, hold on a second. You can see I sold half of these 5 contracts out at a $5.25 credit. Okay, so we took in $2,500 off the table, and what are we left with? Where we can make another $2,500, or actually we can make $5,000. Well, yeah, $2,500. Or if the market crashes, we do have this giant put condor on that we can make money on. It's not likely that this thing is ever going to kick in and make money because it's pretty far out of the money. But we can still use this position, and this is what a lot of people don't even think about, is this is a condor right here, okay? That starts at 28.15 and ends at 27.80. That's pretty wide. it's probably never going to make money. This whole thing is statistically got a really good chance of going out worthless. But that doesn't mean I can't use it to put on a BWB and have this put condor act as some form of protection along the way. So when we're talking, I mean, I said this earlier, one of the things we got to worry about is, and I learned this real quick in my trading career on the floor, is I have to worry more about what's at risk than what my profit potential is. We have on a lot of positions here. Look at all my positions. I'm in Apple, I'm in, Chipotle, I'm in Facebook, GE, IWM ETF, the SPX, the SVXY, TLT, which is the bonds, Tesla. We have some positions on, all these positions on in Tesla. Look at that. This is just Tesla. That's a lot of stuff, right? SPX, I have a lot of positions on. But we're eating up very little margin. Why? Because once we put risk on, the next thing we think about is taking risk off. That's our job as floor traders. That's your job when Tom's not there to help you. So what do we have on? We have on a gazillion options, and you see they're all 5s and 10 contracts, and we only have $27,000 in margin being used. Okay, so I know worst case scenario is I'm going to lose $27,000. I mean, it's an oversimplification, but look, these aren't one lots. They're all 5s and 10s. I got 20 lots on in smaller things like the SVXY and the TLT. But you'll see a lot of the stuff is broken up evenly with calls and puts because we're doing a lot of risk reversals, especially in the SPX. Okay. So, I hope that answers that last question. I'll show you more. I mean, I've got to add more because I've been just peeling off a lot the last couple of days. But Friday, we have on a risk reversal that we've been taking off a little early. We have some on for Mondays. We have some on for August that you see. Here's a risk reversal. I don't even know if I can fit it all on one screen here. I'll show you real quick. I know I'm eating up a lot of time, but here. This is a great example. This was time period number 1. We bought a call spread and sold a put spread. Sounds like a risk reversal. As the market moved, I sold a $5 call spread to take in money to hedge off my put spread. And when I'm long a 10 contracts of a call spread and short 5 further out of the money, what do I have on? 5 condors and 5 call spreads. Then as the market went even crazier higher, sold 5 more call spreads. And I'm trying to get, I bought 5 more put spreads to hedge the last of these. I didn't have to, but what I'm doing right now in the podcast is demonstrating how I'm going to try to get the puts higher than my calls. So when I'm long puts, higher strikes than my long call spreads, what do I have on? Guts or a mambo combo where you can't do anything but make money. Because one of them has to be in the money at expiration no matter what. Now, will it happen? I doubt it. Anytime I show off and say, hey, watch this, hold my beer, it always blows up in my face. It never works out.
And Ted says, so when you start, you expect it to be moving up. I guess that's if you're selling a risk reversal, but you take a directional opinion, right?
Typically, well, by definition, you have to take a directional opinion.
Right.
right? Because you're buying a call spread and selling a put spread, or the reverse. Now, the great thing about this current market is we're in the biggest bull market in the history of mankind. You may pick the wrong day to get into it, but I'd say 90% of the risk reversals we started have been from the bullish side, but I also use them as a hedge, right? Right now, the SPX is at 28.57. Let's say I've got a lot of long deltas. My long deltas are pretty much small. I've been carrying about 150 SPX long deltas for a while, but right now you'll see my total SPX position is getting pretty small. I'm getting really hedged off. My long deltas are pretty much flat. Okay. But let's say I had some long deltas. I wanted to protect it. What can I do? I can go into, say, some 5 days out. Well, I already have a 5-day out, so I'll go into something where there's no litter or positions. And say, where do I think the market can't go in the next 7 days to the upside? Well, there's a lot of different ways we can go about determining it. We can go off a gut. We can say, well, the all-time high in the SPX is what, and sell something beyond that. Or we can say 2,900. We've never been above 2,900. That might be resistance. You may be wrong, but you pick something. And let's say you just start with statistics. We know 16 delta is the 1 SD line. So let's just find something greater than 16 deltas out of the money. Here's our delta. So statistically, the 2885 line is 1 SD line. So let's just sell this for 40 cents because there's a very good chance that we're not going to go above that line statistically. And then we just take that 40 cents and I don't know, buy a $10 put spread out of the money. So we're buying this, selling this. We take in 40 cents here. This put spread is going to cost us what, 60 cents. It'll be a 20-cent debit, but then I can sell this small spread for 20 cents. And I have on a short call spread, a long put spread, and a long put condor for 0. And I can use that as a hedge to the downside, as a starting point. But yeah, to answer your question, Tom, you got to take an opinion by definition, one way or the other. We've been doing really well, just waiting for a pullback. Every pullback, we just put a new risk reversal on. Recently, we kept bouncing off of 2,800 in the SPX. And so we used 2,800 as a support line right here. Every time we got down to 2,800, put on a long delta risk reversal. And if it didn't work out, we've got a dead zone, or we can use the downside short puts we have and use that as half of the broken wing butterfly or something else to hedge it. It's a very versatile strategy.
And Ted asked, do you do a risk reversal to neutralize the position before you close, before the close of the day?
It really depends on everybody. Okay, I mean, we're talking about my trading style and my opinions that are almost unpredictable because I'm getting data every single day about tariffs and trade wars and, is Trump going to be indicted or impeached or not? I mean, the news is changing every day and my opinion's changing every day. I don't mind carrying long deltas. I don't want to be crazy long. I don't want to own 5 call spreads that I paid $1.50 for, because one down day and you got a disastrous P&L swing against you. But long deltas via risk reversals or butterflies or BWBs or something like that doesn't really bother me that much. Especially if the long deltas came at no financial debit. And if I have BWBs on protecting the downside of any adverse move lower, even though I'm carrying long deltas, I don't mind it. Other days, I'm delta neutral. Today, I'm pretty much delta neutral. Most of the time, you'll see me with about a long 100 SPX deltas. Because we're in a bull market and no one can predict when the top is. But because we have all these risk reversals that are coming to expiration on Friday or Monday, I've been taking them off, and that's been decreasing my deltas. So I'm going to be adding more long deltas by the end of the day. I'm going to be placing something in Tesla. I don't even know what Tesla's doing. Let me take a look. But since yesterday, it's been crazy. Okay, it's down $8 right now. I haven't seen the news since we started, but I'm probably going to add a risk reversal in Tesla in a little bit. But by the end of the day, I'm going to do another risk reversal somewhere. So if anyone wants to sign up for the free pod class, if the office can get your names in fast enough, we'll start you today. And you can get an example with what's going on in the markets. And then hopefully it makes a little bit more sense of what we're trying to accomplish here.
And I had one question. I know you said the book's coming out with a version 2. Is there any going to be special pricing if somebody buys the book now versus waiting?
You're better off waiting.
Okay.
You mean the BWB book, the second version?
Oh, the Advanced Risk Reversal book.
Oh, no. I'm probably was confusing you. There's no second Advanced Risk Reversal book coming out. Somebody was asking me about the One Strategy for All Markets, the BWB book, and if a second version was coming out on that. And I said, yeah, it's about 2 weeks from now. Typically, when we have if we do anything for advanced risk reversals type thing, any updates on that, because for whatever reason, if it's something small, we just give it away for free to anyone who's ever bought the book. Or if it's something huge, it's a minimal cost, like $99. Instead, people having to go out and buy a whole new product. We try to cover the printing costs and shipping costs.
Quite fair.
But most of the time, if it's a little adjustment, we'll just send you an email version. And if people steal it and it propagates the internet, it's not going to do them any good without the book anyways. It's sort of like learning how to close on surgery without learning the surgery. So Go ahead and steal away. Market moves up, you take half the call, debit spreads off, and you do a risk reversal to the other with puts. That's one way of doing it, Ted. Personally, how you start reversing the risk reversals is going to be subjective and what you personally like. Me, I have no problem being short at 10 contracts of a put spread. If I'm long 5 contracts of a put spread at higher strikes and have an unbalanced condor on, because they behave a lot like a broken wing butterfly, and I'm very comfortable with those. Some people aren't comfortable with it. And if they're short 10 contracts, they need 10 long contracts to sleep at night. That's fine too. The most important thing in trading is to trade in your comfort zone. You don't want to trade like me. You don't want to trade like Tom. You want to trade in what's going to provide you the best sleep possible. Other times, I'll buy 10 risk reversals in terms of deltas, long 10 call spreads, short 10 put spreads. With the when we get really close to a support level or a resistance level, especially resistance levels. Let's say we're heading and we get to 2770 in the SPX, and I for some reason think we're going to hit 2800 and test it. I will get long for just a little bit of a ride, a couple hundred Dow points. I'll buy call spread, sell put spread, and then when we get near resistance of 2800, I will not only hedge it and turn it into condors, I'll flip it. I may be long 10 call spreads. I'll sell 15 further out of the money, turn the call spread into almost a call BWB of sense by selling a few extra call spreads, and use that to buy a few extra put spreads, take my bullish position, turn it into a bearish position that's protected. And so if we fall, if we hit a resistance and fall, I can flip again and just keep flipping it. Every time we go up, I'm getting long deltas. Every time we go down, or every time we go down, I get long deltas. When we go up, I sell out of those long deltas and get short deltas. And then on the way down, I just keep flipping it.
Hey, Scott, can you hear me?
What amount do we use for money management? I will never, ever, ever put more than 5% of anything we have in the account into these things. So right now the account's at close to 200 grand. So technically I could put 10 grand into it, but I'm still only doing $5,000 or right now I started out at 5,000, which was 5% at the beginning of the year. Right now it's down to about 2.5%. But I found that when the P&L swings start getting bigger and bigger, it upsets the students. Okay, I get a lot of emails of people a lot worried about what the heck I'm doing and how the last time the market was down 200 points, I lost 1,000, but now I lost 2,000. What's going on? Am I doing something wrong? Am I not managing it right? So technically, as a floor trader, as my dollar values in my account increases, I should be staying with that same 5%. So if I start out with 100 grand, I should be at 5 grand in risk. And then when we go to 150 grand, I should be at 7,500 in risk. And when we get to 200 grand, I should be at 10,000 in risk. I did that 1 year and it just freaked people out, especially the people who came in the middle of the year. And so now I start out at 5% and then I stay at the same 5 grand max the whole year. I don't know what happened to the sound.
Yeah, I don't know.
So
if anybody
let's
else
wrap it up. I already went a half an hour or more longer than we anticipated because we've had so many great questions I wanted to answer. And Tom, I want to, first of all, thank you deeply for trusting me to talk to your students. But I also want to apologize for going over the time. I think I got done in my 90 minutes that I promised, but we've had so many great questions that I didn't just want to rush people through. When you got a great question, I don't want to sound dismissive and say, that's a great question. The answer's 4. Next. So hopefully I answered everyone's questions.
Yeah, thanks for coming. I don't know if you can hear me.
Tom, I can't hear you, so I'm going to let you close everything down and say goodbye to everybody for me. If you have any questions, just ask Tom or contact the office, and one of the girls will be more than happy to help you out. Again, thank you guys for your kind attention. You've been a really polite crowd, and I thank you for it because I'm a very sensitive man with very sensitive feelings, and if you were hard on me, I would have been crying. I'm a floor trader. If you want to insult me, you got to pack a lunch. Anyhow, everybody take care and have a great day. Let us know if you have any questions. Bye-bye.
Yep. Thanks.